Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello, my name is Vinay Joseph and I'm the Chief Investment Strategist at Standard Chartered Bank India. In continuation of our series of podcasts delving into our key asset class views for 2022, today we discuss our outlook for bonds for the year ahead. We view bonds as a core holding. A reflationary macro environment, higher fiscal spending, tighter liquidity, and a quicker withdrawal of monetary policy stimulus by the RBI and the US Fed are likely to drive bond yields higher over the coming 12 months. We expect the benchmark 10-year IGP bond yield to trade around 6.5 to 6.75% over the next year. In our assessment, yield premiums, that is the spread between the 10-year IGP yield and repo rate, are attractive and are at peak levels. Economic growth recovery and strong corporate profitability is likely to result in a reduction in default risk, supporting a further compression of corporate bond yields premium, especially for AA and single A corporate bonds, which appear inexpensive on a relative basis. In addition, higher real yields compared to emerging market peers and light investor positioning amid India's possible inclusion in global bond indices is a supportive of bonds. However, three factors for bonds remain unfavorable. First, fiscal deficit is likely to remain high over the medium term. Second, government bond demand-supply balance continues to worsen, given a high supply of government bonds amid muted demand by institutional investors and waning RBI support. And third, the RBI's normalization of policy rate as well as excess liquidity is likely to exert upward pressure on bond yields. Going into 2022, we believe a diversified bond allocation can help investors tide through an environment of rising interest rates. Our first preference is for corporate bonds over government bonds, given better macro fundamentals compared to weak fiscal dynamics. We prefer high-yield corporate bonds on a likely reduction in credit default risk amid improving corporate profitability and inexpensive valuations of AA single A corporate bonds relative to AAA corporate bonds. Our second preference is for short maturity bonds, given lower price sensitivity to rising yields compared to medium and long maturity bonds. Further, the rise in short-term yields over 2021 reflects RBI's normalization of excess liquidity and expectations of a rising interest rate trajectory. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.